the committee has become convinced that further policy accommodation is warranted to strengthen the recovery and support the gains we've begun to see in housing and other sectors.
As you hear there, Ben Bernanke firing up his helicopter, vowing to flood financial markets with $40 billion a month to try and kickstart job creation. I'm Jamie McGeever and this is Market Pulse. Well, this flood of liquidity boosting virtually all assets and gold more than most, the precious metal at its highest since February. Out now to Michael Vidmer, he's metal strategist at BofA Merrill Lynch Global Research. Michael, well, for gold then, the only way is up, right?
Well, look, we appreciated that during the year it was kind of challenging for a whole lot of different factors for gold, but we always thought that the second half, in particular the fourth quarter, would be quite strong. We have maintained throughout the year our price target of $2,000 pounds, absolutely, and I think I'm confident that we're going to hit that through the fourth quarter and into the first quarter next year. So
possibly $2,000 an ounce by the end of the year?
Potentially.
Now, is this bullish forecast, is this based on the inflation fears that this liquidity may inject, or is it against the backdrop of weak global growth?
It's interesting that you say that, and I think when you're talking to the investor space, different investors have different motives. I think the inflation fear was always one reason after the big recession, when we did see the first amount of liquidity hitting the system, why investors bought. I think concern about the strength of growth, and I think the Fed highlighted again that 2012 in particular may look quite challenging, is another reason I think why people or why investors bought into the gold rally. I personally also think, and this is probably important when you're looking at the rate guidance, we're not going to see higher rates out until 2015 now, and that means in real terms interest rates in the United States, particularly at the front end of the curve, will remain negative, and that is very positive for gold as well.
And today, of course, we're also seeing the long end, the 10-30-year sector of the US curve sell off a bit. I want to ask you about gold in euro terms. We're very, very close to an all-time high in euros. Do you think we'll get there, or not if, but when?
It's an interesting one. I think what I would say on that front is that the US dollar, particularly when you're looking at it relative to the euro, has on the one hand often been driven by what's happening in the US, and there was at stages not particularly good news out of the US economy, and then on the other hand on what is happening in the Europe, and often there was not particularly good news out of there either. Now, what I would say, in an environment where you have got a lot of support from the monetary side, you can see how the dollar may not initially be particularly strong. So I wouldn't be surprised if we did see a prolonged rally there going forward.
Okay, Michael, thank you very much and have a great weekend. Well, another result of the Fed action, of course, as Michael touched on there, is a weaker dollar. Technical charts suggesting that there may be further downside for dollar yen. So says Barclays Capital's technical strategist Phil Roberts in our chart of the day.
What we've seen over the last month or so is breaking lower below weekly cloud support. That has then been followed by daily cloud support providing resistance and really pushing the pressure on the range lows highlighted in that triangular formation. Below those range lows, the low in May was 77.65. Would put the market on a collision course with the Bank of Japan, which in 2011 was intervening between the 75.50 and 76.50 area.
That's it for now, but do stick with Reuters. On the Insider platform, Jim Bianco and Wells Fargo's Brian Jacobson argue the Fed's bond buying is distorting markets. I'm Jamie McGeever. This is Reuters.